All right, excellent. Right, so like I said, we're the fifth largest advisory and audit firm worldwide. Revenue is nearly $12 billion. We're growing year on year, more than 95,000 people worldwide, with a presence in 164 countries and with offices in 1,713 offices worldwide. We provide the full range of services, which is accounting and audit, business outsourcing services, tax, and also advisory services. In East Africa, we have a presence. The partnership here is an East African partnership, and we have a presence in 5 countries with dedicated teams: Kenya, Tanzania, Uganda, Rwanda, and Ethiopia. And obviously, we've got a presence worldwide, in another 1,713 offices, but our partnership here is basically in these 5 countries. These are some of the services we provide. We provide a full range of audit and assurance services, taxation services, advisory services, which is where I sit, and specifically forensic services, corporate finance, restructuring, corporate recovery, management consulting, internal audit, and risk. Now, let's get back to the agenda for last week. Okay, so what's the agenda for today? We're going to summarize the first 3 parts very, very quickly. I promised in our last webinar that we're going to give you the results of the fraud prevention checkup by industry sector. So we've done that. We've done quite a lot of analysis, and we've got some excellent feedback to share with you. Then we're going to dive in and look at common fraud types and how to detect and prevent them. We're going to look at more than 40, 50 different frauds. We're not going to have time. Obviously, this is 1.5, 2 hours max. We're not going to have time to go into detail with every one, but we did identify what were the high risk departments and the high risk frauds, and those ones we're going to delve into. And then we're going to look at code of conduct. We'll go through some forensic accounting standards, global standards, and we'll then look at evidence, the law of evidence, the types of evidence, and some of the rules and principles in evidence, and then we'll have a wrap up. So coming back to the report to the nations 2022, this is a report done by the Association of Certified Fraud Examiners. They've been doing these reports biannually since 1996. And all I'm going to do is take you through the key highlights that are relevant for today's session. That's it. So starting with the perpetrators department. In this particular slide, we looked at the departments that were high risk in terms of fraud. And on one side, you've got the loss up to $500,000. And on the other side, you've got the frequency of fraud, the occurrence. And you can see at the very top 2, the most senior people in the organization, they perpetrate the largest frauds, which is the board of directors and executive upper management, including business owners. And then when you look at departments within an organization, you've got finance, accounting, information technology, purchasing, operation, and sales. And we're going to look at all of those, as well as warehousing and inventory. All of those are fairly high risk with large losses for all businesses. Same slide with numbers, so you can go back and have a look at this. This is a heat map. Again, departments and the type of frauds. And again, you can see here, corruption is the greatest, and bribery is the greatest fraud risk. But you've also got, in terms of executive and upper management, you've got billing, which is quite a large fraud. In the accounting department, you've got check and payment tempering. We'll look at that as well. In purchasing department, you've got billing. In finance, also, you've got billing. So this gives you a fairly good idea of which frauds to look out for and where to put controls first. And this is what we're going to look at today. We looked at behavioral red flags, and these are really important because we'll keep coming back to this. Every fraud category that we go through, you're going to see these over and over again, because these are the basics. This is how you pick up fraud. The first signs of fraud are going to be in behavior. It's very rare that the financial numbers impact straight away. Before that, there's going to be whistleblowing, there's going to be all sorts of signs. So without going through this checklist, you need to have this slide somewhere and basically make sure that you're looking out and your people are trained to spot these behaviors, particularly in the high-risk areas. And similarly, HR-related misconduct. We had signs, and basically those signs were fear of job loss, poor performance evaluation, denied raises or promotions. And that's why during the COVID period, we found there were even more frauds, because we've been through a period where a lean period, where there was job cuts, where there were no pay raises or very minimal pay raises. There was a fear of job loss, and the frauds went up. The behavioral red flags for frauds, these are the red flags that have been there in every single survey done by ACFE, and it's worth knowing these ones: living beyond means, financial difficulties for the perpetrator, unusually close association with a vendor or customer, controlling issues, unwillingness to share duties, irritability, suspiciousness or defensiveness, bullying, intimidation, personal problems, family problems like divorce, and then a general wheeler-dealer attitude. This is fraud risk by industry. And again, you can see here, depending on the industry, you can use this matrix to zero in on the specific frauds. And that's what we're going to try and do here. So the two heat maps in the survey, both very useful. Here we looked at the impact of anti-fraud controls. And basically, to remind you, the blue lines were with when you had controls in place and what the median loss was, and the light blue lines when the controls were not in place. And you can see everywhere that, particularly on the left-hand side, the median losses were nearly double. So that's where the low-hanging fruit are. If you quickly go through them: job rotation, mandatory vacation, having a hotline, conducting surprise audits, proactive data monitoring analysis, having an anti-fraud policy, providing fraud training for your employees, conducting formal fraud risk assessments, having a code of conduct, and not just having it, but actually getting employees to understand what their obligations are, what their responsibilities are, and making this a living document. Same sort of information in a numbers form. And then this is to do with the duration. And again, we can see the same pattern. So low-hanging fruits here. Make this a checklist in your organization and make sure you've got these things. Try and do the ones on the left-hand side, because they're very quick to do. A lot of them don't cost a lot of money. And then obviously you can come down further to where there's to the right-hand side. This one, if you remember, the use in terms of hotlines, in terms of reporting, whistleblowing, what we've seen in the last 2 years to 4 years is that email and web-based online methods of reporting have taken over from telephone lines. So make sure that your organization has got, your employees have got access to a form which is online, where they can report, and also email-based. So they can do anonymous reporting to dedicated individuals, and that everybody is aware that this is available, and not just for your employees, but also for your other stakeholders, like your suppliers, your customers, and so on and so forth. We did a fraud prevention checkup last time, and this was quite an exciting exercise, slow to take off. Just to remind you, there were 7 areas where we asked questions, and this is the weighting. Do you remember I said we can't do this in Zoom, but we've done the analysis now. We've given your responses weightings in this manner, and this is the weightings prescribed by the Association of Certified Fraud Examiners. The minimum score, the maximum score is 100, but also your ideal score, if you're doing all of this, should be 100. So anything less than 100 is scope for improvement. It means you can do things in your organization to reduce fraud risks. This may not be very visible, but it's the best we could do. We've got here the number of participants. I think we had just over 600 participants last time, but because of difficulty, only 240 were able to participate. So those are the results we've got. You can see we had lots of people from financial services, consulting and professional services, manufacturing services, retail, logistics as well. So we had a fairly good representation, including government, legal, and technology. These are the responses by question number. So going from the highest score to 10, you can see almost in every area, the first score is 16.5 out of 30, just over 50%. The next one again, fraud risk oversight, 11 out of 20, just over 50%. And it was the same story right through, which means 50% of respondents had the controls and about 50% didn't. So huge opportunity to do something in your organization to stop the leakage of cash and assets through fraud. This is very interesting, and I think this is just worth its its weight in gold, really. This tells you the responsiveness by industry, and you can see here the industries that are regulated scored quite highly because they are required to have these controls in place. But again, they've got room for improvement because they had less than 70%, less than 100%. I mean, you're talking about 60, 65%, still 1/3 area or more than 1/3 area for improvement. But then looking at the rest, everybody, I think, lots of room for improvement. And then looking right at the end, sad to see our legal friends who are supposed to be advising us on everything. They probably have, maybe they're not worried because they know they can sue, the pants of anybody. So they're not really worried about fraud. But I mean, they have the highest opportunity for improvement, and also in manufacturing and government. Right. This tree or this taxonomy keeps coming in front of you, and this is where we're going to focus today. Remember, I said from the very beginning, you need to understand how fraud happens in your organization. And if you don't understand the different frauds that are perpetrated, then you really can't do anything about them. So the first thing that we're going to do is, over the next maybe 30 minutes or so, is we're going to spend a significant amount of today's time, maybe an hour, looking at this. I'm going to describe the actual fraud that happens and what it is. So that gives you an understanding of, how somebody can take advantage of weaknesses or opportunities in your organization. The next thing I'm going to do is I'm going to choose a sample based on the high risk areas that we've already addressed. And we're going to go in depth and look at specific things that you can do in your organization to catch the fraudster and to detect fraud. Right, so let's go. Asset misappropriation. This is the first category, and there's loads of different frauds that happen here. So asset misappropriation, it's a broad term that describes a whole range of frauds, but essentially it's the theft of company assets by an employee. It's also known as insider fraud. So what's check forgery? That's a pretty obvious one. An employee writes out a check to himself. They either forge a signature, they forge the payee, the payee, and they transfer the proceeds to themselves. Check kiting, it doesn't happen so much these days because our clearing times have gone down, but this is when an employee writes a check on an account that doesn't have sufficient funds with the expectation that the funds will come in the account before the check clears. Check tempering, the employee alters the payee or other amount or details on a check, and he creates a check that obviously wasn't authorized. Inventory theft, this is a big thing that we're going to look at today. And this is when an employee steals a product from a company, either by physically taking it or by diverting it in some other way. And we'll go into quite a lot of detail on that one. Theft of cash. This is the most common in some environments, for example, retail, where cash exchanges are common. And this type of fraud covers simply stealing cash or skimming cash, which is basically not registering cash before taking cash before it's registered in the organization. Return fraud, where an employee colludes with somebody else to return goods fraudulently for a refund, or any other scheme that involves the removal of hard currency. Then we've got theft of services, where an employee misuses the company's services or company funded services. For example, at an auto shop, the mechanics, somebody can get mechanics to do his oil changes for free just because he's working there. Expense reimbursement fraud. This is also called expense fraud. And this type of fraud includes forging receipts, double claiming for expenses, submitting false reimbursement claims, inflating expense claims, and so on and so forth. Then the next one is expense account fraud. And this is where an employee uses a company expense account for personal expenses, and he submits them as business related. Sometimes this is also called expense reimbursement fraud. And then there's procurement fraud. This type of fraud includes schemes such as over-ordering a product, then returning some and pocketing the refund. It can also include purchase order fraud, where the employee sets up a phantom or a fictitious vendor account into which are paid fraudulent invoices, or initiating the purchase of goods for personal use. This is a big fraud, so we're going to look at this one as well. Then you've got payment fraud. This covers vendor fraud schemes, and such as creating false customer accounts to generate false payments, but it can also include altering employee pay details on checks and payables, or self-authorizing payments and colluding with others to process false claims for benefits or payments. Then you've got health insurance fraud. This is where an employee conspires or colludes with healthcare providers to defraud an insurance company. So this is not on you, but it could be through your organization to defraud an insurance company by submitting false or inflated receipts. Commission fraud, where an employee inflates sales numbers to receive higher commissions, or falsifies sales that did not occur, or colludes with customers to record and collect commissions on falsified sales. And then personal use of company vehicles or other company assets. So how can we prevent and detect asset misappropriation? Well, again, basic things. And unfortunately, you're going to get these basic things coming in before the specifics in almost every single fraud category, but we have to go through them. The first one is conducting thorough background checks on new employees, implementing checks and balances, separation of functions, job rotation, random audits, payment of commissions, and custody of checks, keeping checks in locked cabinets and destroying voided checks, and also providing a method for anonymous reporting. Let's look at preventing inventory or warehouse theft as to start with. This is the theft of stock or inventory. This normally happens in a big way in warehouses. And basically, you've got to ensure, the first thing you've got to ensure is that your inventory is correctly tracked, so that you can tell the difference between the different types of losses that you may suffer. You can see here in the diagram, you've got to be able to track your losses due to spoilage, your losses due to obsolescence, your losses for items that are on display or others that are damaged may have been returned, maybe not accounted for. And then obviously the difference between these and the discrepancy between physical stock and a stock count is shrinkage. Now, one of the things that you should do is, if you have a business where you're stocking items in a large warehouse, you should have a warehouse management system. And one of the things that this allows is for you to do cycle counting. Now, what is the benefit of doing cycle counting? Well, the first benefit is that it doesn't require you to shut down your entire business. It ensures that your inventory is counted regularly, almost on a daily basis or on a weekly basis, and it's much easier to spot theft that way, because you're basically just taking bits of inventory and you're just going around and looking at them. Stock takes sometimes, particularly when you have large warehouses, they're much more difficult to do. So this is a good way to, and then obviously you're going to supplement it with full stock takes as well. But the thing about cycle counting is it's got to be unannounced. So where you're going to check on a daily basis, nobody should know that except the person who's doing the check. And that obviously is going to be a big deterrent to anybody who's looking to take stocks, because they know that it's going to get found out, maybe the same day. So what are some of the red flags for warehouse theft? First of all, your stock levels don't match your recorded sales. That could be the first red flag. The second thing is that your sales seem to dip on days when particular staff are on duty. So look at if you've got sales dips on particular days and on other days sales are high, look at the particular staff who are on duty on that day, and that might tell you something. The next thing is if you've got staff rumors that theft is taking place, take that very, very seriously, and instantly try and start monitoring and try and start doing surveillance. And the other thing is certain members avoid taking their annual leave. That could be another red flag. Or important documentation such as invoices are missing or appear as duplicates rather than originals. And then the other thing is stock is constantly found near exits or loading bays. So if you've got this situation, instantly the red flags should go up. So what can you do to prevent warehouse theft? Let's go into a little bit more detail now on these bullet points. The first thing is conduct background checks before hiring new warehouse staff. I mean, this seems like a no-brainer, but if you don't do a basic background check, this will drastically decrease your chances of finding fraud in any area. And the thing about background checks is you can check so many things. So you can check for educational qualifications, you can check for criminal records, you can check for past employment records, periods of service, the reason for leaving, whether they even have the expertise, the service or the industry expertise. You can do a credit check. The bottom line is, when these background checks are done properly, then your hiring process becomes fair on honest employees, because you're going to catch the dishonest employees, people who are not exaggerating their qualifications, they're not exaggerating their experience, they're not lying about previous employment and so on and so forth, will get caught out. So this is the first thing you must do. Next, educate employees about company policy on theft. Make sure all your staff are aware that you have a zero tolerance policy when it comes to theft or fraud. Have them sign a code of conduct that clearly outlines how violations will be punished. Provide anonymous channels for staff to report any suspicious activity. If everyone knows that their colleagues are keeping an eye out, it will deter the thieves due to a higher chance of being caught. And then deal with thefts immediately in line with your company policy. If you experience a theft or a series of thefts, take a look at your shift register to see who was on duty when the stock went missing. If you begin to notice a pattern between missing stock and certain staff members on duty, monitor their activity in the warehouse. If you notice suspicious behavior, such as consistently clocking in or out at odd times, then you might need to investigate further. Also, maximize managerial visibility in your warehouse. Having a strong managerial presence on your warehouse floor is definitely a deterrent to theft. But obviously, if your manager can't spend too much time on the floor because they have too many duties, they've got duties on the computer, they've got to work on their desk, then you should consider investing in a warehouse management solution that provides a mobile component. Yep, so look into that. The advantage of obviously having something with a mobile component is when your manager's on the warehouse floor, he can obviously look at cycles, look at the data on the stocks and update it immediately and take action straight away in real time. The next thing you want to do is you want to limit access to stock in your warehouse. So use the physical layout of your warehouse to create barriers that help to prevent theft. Separate your receiving and shipping docks where possible to prevent newly received stock exiting on, say, an outbound truck before it even enters your warehouse. And you keep your pick faces, the area where goods are picked, keep your pick faces and your inventory storage locations as far away from your shipping and receiving areas as possible. Common sense, but again, it needs to be stressed that that's how theft occurs. The only stock that should be near these areas are incoming and outgoing orders. And then provide visiting truck drivers with a dedicated lounge area to wait while orders are being loaded or unloaded. And only staff should have access to your warehouse or distribution area. Next, ensure you have robust security systems in your warehouse. So security systems like access control and CCTV cameras are definitely strong deterrents because they provide evidence of theft. So invest in, and these days, you've got fantastic high resolution digital cameras with night vision, and they move with the people. So yeah, invest some money in CCTV and place them in strategically high risk areas. You should also install security cameras to maximize the visibility and prevent blind spots in hard to reach corners of your warehouse. And then, like I said before, make sure you've got unplanned visits by your supervisors or team leaders as an additional deterrent. Be sure to inspect any vehicles leaving your warehouse to check for unauthorized stock leaving your premises, and separate the staff and visitors parking. These should be located separately from your warehouse operations. No private vehicles should be allowed near your warehouse. Right, next, understand the motivation. Now we went through this. Remember the fraud triangle and the fraud diamond and then the fraud pentagon and the fraud hexagon. I'm not going to go through all that again, but I mean, you need to understand, why do employees steal? And in an ideal world, obviously we wouldn't have to ask these questions, but we know there are 3 reasons, and we talked about them, why employees develop light finger. The first one is need. Well, in our situation here in Africa, it's going to be poverty. So very often when an employee is struggling financially, they might be tempted to steal from their employer, either taking items home for their family or to sell them for cash. And their justification is they need the items more than you do, thinking that you're not going to notice, and they may be able to replace the missing stock later on. The next reason obviously is entitlement. Some staff simply believe that okay, the company they work for owes them something because of something that happened, and they start pilfering stock as a result, just to take what they think is rightfully theirs to begin with. And then the other one is opportunistic theft, which happens because you didn't put enough controls. They can take small items, or basically, they've got the opportunity to defraud you, and then they're going to do it. And finally, implementing a warehouse management system, which allows you to do cycle counting. The next fraud we're going to look at is vendor fraud. And vendor fraud can be committed by employees acting alone or in collusion with vendors. So one of the first things you want to do is to examine your vendor files. And let's look at some of the frauds, first of all, before we actually jump into examining those files. So we will go into billing schemes. Like I said, we're going to go into bribery and kickbacks towards the end. So what are billing schemes? In a billing scheme, your employee generates false payments to himself or herself using the company's payment system, either by creating a fictitious vendor like a shell company or by manipulating the account of an existing vendor. Bribery and kickbacks, we know this. Yeah, they're basically doing something and they're going to get a kickback from the vendor in exchange for some kind of advantage. Yeah, check tampering, we've been through. Overbilling, vendor pads the invoice, he basically inflates the invoice to charge the company for more goods than it ships or to charge a higher price than was agreed. And this can be done in collusion with employees who receive a kickback or by the vendor alone because they want to defraud the company. The next one is price fixing. And this type of fraud occurs when competing vendors collude amongst themselves to set a minimum price or price range. So if you're always asking pricing from just 2 or 3 vendors, and these vendors tend to know, who is being invited, so not a good idea to actually disclose who was invited. Keep that secret, and definitely your employees can leak that information. So if your employees, started informing vendors of who their competitors are, they can then go and fix the prices, and eventually you just end up paying high prices, and then the staff gets a kickback. So what can you do to prevent and detect vendor fraud? First of all, the basic things. Conduct background checks, yes. Implement checks and balances on payments, and we'll look at this now in a little bit more detail. Separate the functions of the check preparer and check signer. Rotate duties of employees in procurements, and then conduct random audits. Now let's look at specific things that we can do. We can conduct a due diligence when setting up vendors by verifying the vendor's business name. So, call and find out, or send somebody to the location to see if the thing actually exists. Look at their tax number or their PIN number or their VIN number, to see whether it's real. Look at their phone number, call their phone number, see if they've got a PO box as well as a street address, not just one. Look at their bank account and look at their vendor contact. You can also use data mining to uncover anomalies and patterns. Compare vendors' addresses with employees' addresses to see if there are any similarities. Implement a dual review process for the master vendor file, and then review the vendor master file to check that the volume of billing is reasonable and consistent. Now, specifically, let's look at specific ways in which we can identify fictitious vendors. The first one, look at vendors whose mailing addresses are PO boxes only, with no corresponding street and building address. Remember that fraud I talked about last time in insurance fraud, where somebody had all these fictitious companies, and then the guy was killing employees that never existed, and then diverting the proceeds from life insurance payments to beneficiaries, his own friends. So this happens. Maintain a list of approved vendors, identify companies that are not on this list, look for invoices with even shillings or dollar amounts and with no taxes added, flag invoices for vague services or services that don't seem necessary, look for payments without supporting documentation, compare names, addresses, bank account numbers, and telephone numbers of vendors and employees. Look for vendors who are also health or life beneficiaries of an employee. Look for vendors created using Microsoft Excel or Word invoice templates, fairly obvious. Identify vendors with above average revenues for investigation. And then you can also look for invoices from the same vendor with consecutive invoice numbers. You can compare names of vendors with other similar vendor names and investigate whether payments have been diverted from one to another. You can look at check names. You can check names, of accounts payable employees against public records to determine whether they are principals or registered agents of a company that is a vendor. This is available. This information is available in several countries. You can also look for vendors without TINs or PINs or VINs, or with invalid ones. For example, in Kenya, a valid KRA PIN ID has 9 digits with 2 letters at either end. Then you can compare employer identification numbers, tax identification numbers, VAT numbers to see if more than one vendor has the same number. And you can also look for drastic changes in prices, services, or products provided by a particular vendor. And finally, you can look for a vendor's names that only consist of initials and match those against employee initials. I mean, recently looked at a vendor, that had a name KRA initials, and more than 500 million shillings were diverted from a bank account. Probably somebody in the bank was colluding with the company, and the payments were meant for KRA, but all these payments were diverted to another company, which had a name but was using KRA initials, KRA Limited. Accounting fraud. So what is accounting fraud? Accounting fraud is an employee who manipulates a company's accounts to cover up theft and uses the accounts payable or receivable to steal from the company. So there's a number of different sort of frauds. And this normally happens, these sort of frauds normally happens when there's little or no oversight. So if you've got too much trust, or you've got a very small accounts department, you've just got one person running the department, you're going to be prone to this kind of fraud. So this fraud includes things like embezzlement. We talked about this. This is also called larceny, and it's normally conducted by the person who controls the funds. So we talked about cash larceny. So the person that receives the funds is the one that can steal them even before they're recorded. So hire highly trustable people in that position, or do it yourself, or get a outside company to collect cash. Accounts payable fraud, we talked about this as well. Fake supplier, we talked about this. Personal purchases, we talked about this as well. So I'm just going to go on. I think we've described all of these frauds. How to prevent and detect. Again, implement tighter controls. Goes without saying, no-brainer. If you've got few people, make sure there's oversight. Make sure you're doing your reconciliations on a time. Make sure somebody's crossing the dot and checking the dot and crossing the T's. There's attention to detail in this area. Separate the functions of account setup and approval. That's the next thing. Conduct random audits of accounts payable and accounts receivable records. Assign a trusted advisor, maybe an outside contractor, to review and reconcile accounts at regular intervals. And then rotate duties of employees in accounts payable and accounts receivable. And also make it mandatory for employees to take vacation time. You can also set up a automated positive pay system to detect fraud. Banks use a positive pay system to match the checks a company issues with those it presents for payment. And any check that's considered suspect is sent back to the user for examination. So in countries where this is available, you can get your banker to institute a positive pay system. You're obviously going to have to provide the information upfront, but when the check arrives, then they can be an additional layer because they can spot changes to those checks. And before they pay them, they have an obligation to then alert you. It costs a little bit of money, but it's well worth implementing this. The next fraud we're going to look at is payroll fraud. Payroll fraud is theft via a company's payroll system. And according to the fraud survey, this is a very common fraud. Nearly 30% of all the businesses suffer from this kind of fraud. And when it happens, it lasts for much longer. So payroll frauds go undetected for up to 36 months. So this is a significant risk, especially for small businesses where there are usually fewer controls. Let's look at some of the frauds in this area. So the first one is ghost employee schemes. What is this? A fake employee or ex-employee is kept on the payroll with pay being diverted to the fraudster. This happens a lot in government, particularly where you've got several thousand employees. You could have ghost employees for years getting paid, even after they've left the organization, or they never work for the organization. The next one, advance fraud. This is where an employee requests a payroll advance and doesn't pay it back. So if you've got poor accounting records, your employee is going to take money knowing that they're not going to be held accountable. The next one is timesheet fraud, and this is where the employee falsifies the time that they've clocked in and out, or another employee clocks in and out for this person in their absence. Then the last one is paycheck theft, where one employee steals another employee's check and cashes it. So they can change their name and basically it goes to their account, and then they can do a runner with it. So how do you prevent and detect payroll fraud? Again, same things. Reconcile your balance sheet and payroll account each quarter. Require managers and supervisors to approve timesheets and overtime claims. Institute mandatory vacations for payroll employees. Restrict payroll department employees' ability to modify pay rates and hours in those systems. So they shouldn't have access to pay rates and pay hours and hours. Perform data analytics on payroll records to look for things like matching addresses, names, bank accounts, and so on and so forth. You can also check payroll records to ensure that terminated employees have been removed from the payroll. And finally, you can separate the tasks, preparing payroll checks and reconciling payroll account. Let's look at some of the red flags. There's loads of red flags for payroll fraud. So you may have unrelated employees with the same address, or you could have two or more employees with the same cell phone number or home phone number. You could have multiple employees using the same bank account number. You could have one employee using multiple bank accounts for direct deposit. You could also have an employee who is on the payroll, but not on the company's employee list, so ghost employees. You could have an employee with an address that is just a PO box or mail drop without a street address. So ask your employees where they live. You could also have missing information in employee files. You could have an employee who shares an address, telephone number, or bank account number with an accounts payable vendor or supplier. You could also have payments to employees for holidays, weekdays, or off days. Look for gaps in check number sequence. Another red flag is a terminated employee who is still on the payroll. Larger companies, this might go unnoticed for a long time. Unusually high overtime pay, or an employee who's been paid for working more than 24 hours in one day. Yeah, some of you are going to be laughing, but I tell you, it happens. Employees with more than one address change within 1 year, another red flag. Duplicate paychecks. And then you've got blank social security numbers, unusual number of checks issued for an employee in a year, invalid social security numbers when you match them with employee records, multiple employees with the same social security number, employees on the payroll register before their start date or after their termination date, deceased employees who are still on the company payroll, manual payroll checks, another red flag, multiple paychecks issued to an employee within a single pay period, and then employees with no deductions for taxes or benefits. Large companies, I mean, if you just do a quick data mining and just single out employees where there's no taxes or no benefits, or people who've never gone on leave, they've never been sick, you're going to find all your ghost employees. One quick data mining check. Unusual ratio of gross to net pay. Bonuses paid during times when bonuses are not typically paid, or to employees who are not eligible. Employees with no pay increases or more than 2 pay increases in a year. And then employees who've had no paid time off, vacation or sick leave, just as we said. Right, the next area, this is huge. So I'm literally just going to be scratching the surface. We will be holding other webinars specifically for this particular area. That's how big this is. But yeah, let's just very quickly go through it. So data theft, I mean, today we know is a major problem, and that nearly all 50% of organizations have suffered a data breach in the past year. This is what surveys tell us. Also, personal data is now the world's most valuable resource, and collection of it and theft of it shows no signs of slowing down. So in fact, providing some piece of personal information, whether it's your email address or name or mailing address, it's necessary to receive almost any product or service these days. But thanks to this, the value of data today and the fact that it's increasing every day, threats are just on the rise. So if you haven't suffered a data breach, or you don't know that you've suffered a data breach, I can almost tell you, you will. And the chances of that happening at any particular point in time are over 30%. That's what surveys tell us. So let's look at the types of data theft that can occur. And I'm only going to look at these three. Theft of proprietary information to sell it to a competitor, that's trade secrets theft, or a departing employee copies or downloads your lists of company contacts to either sell or to use, or theft of personally identifiable information. They steal details of things like credit card numbers, client lists, or any other personally identifiable information, and they might use it themselves or they might sell it to third parties. So how do we prevent and detect theft? Restrict access to company proprietary information to only those who need it in the course of their jobs. Set up IT controls to alert management of large downloads or transfers, or downloads and transfers that occur at odd times. Purchase software that alerts management of suspicious activity on a company network, such as an employee trying to access sensitive information. Dispose of confidential information properly by shredding documents or completely removing data from electronic devices before redeploying or disposing them. Use strong passwords for all computers and devices that can access sensitive information, and implement a clean desk policy, one that prohibits employees from keeping sensitive information on their desks while they are not present. Let's look at some specifics that we can do in terms of protecting our data. There are, as we know, there are endless laws, and I mean, these days, there are multiple laws in every country. Most countries in Africa now have data protection laws. We got ours in Kenya in 2019. So depending on your industry and type of data you collect or store, you may have to comply with a number of data security laws. And the best way to be in compliance is by creating a data security policy that keeps data safe from risks, both inside and outside of the company. So, I mean, the first thing you want to do really is understand the law of the country. And in fact, not just country, but countries. If you're a regional business or you're an international business, then you need to understand the laws, not just of your country, but the laws of the country to where your products are going, the other way you're doing business. So the next thing you can do is to create a data security policy. Your policies should really be designed around the 8 principles or 7 principles of data protection laws. I think we all know what these principles are, but I'll quickly go through them. The first one is lawfulness, fairness, and transparency of data. You've got to collect data in a lawful way. You have to be fair in your collection, the way you collect data, and any communication where you're collecting data has to be completely transparent. The second principle is that purpose limitation. You can only collect data for the purpose that you're using it, and you cannot use that data for any other purpose. The third principle is data minimization. When you're using data, when you're collecting data, you need to collect the minimum data, and once you've used it, you basically need to discard it. Accuracy, your data has to be accurate. The principle makes the organization responsible for keeping the data accurate. You can't keep data that's not accurate, whether it's email addresses, phone numbers, physical addresses. It has to be accurate. And the moment it gets inaccurate, you have an obligation to get rid of it. Storage limitation. You can only keep data for a certain period, basically. And once you've used the data for the intended purpose, you need to basically get rid of it. Integrity and confidentiality. You've got to, this used to be the security principle. You've got to make sure that all the data you're holding is confidential, and its integrity is complied with. And then there's also provisions for international transfers, and this whole separate law for this now. And then finally, you've also got a principle of accountability, whereby organizations who have data are being held accountable. And then the other thing in terms of just the law is the law now has given lots of rights to individuals. So they have the right to be informed. They have the right of access. They have the right to rectification. They have the right to erasure. They have the right to restrict processing. They have the right for data portability. So there's loads of rights that the owners have themselves. Right, so basically some quick guidelines in terms of your policies. First of all, keep data transferring at a minimum. Shed paper files always. Only keep data that's required to carry your tasks. Don't keep unnecessary junk data. Change passwords often and make each one unpredictable and hard to crack. Use symbols, special symbols, use numbers, use upper and lowercase. Clearly define computer policies and acceptable use. Request that employees sign a policy that touches on things like trusted and untrusted websites. For example, Google, Wikipedia, YouTube, and so on and so forth. Use the cloud when it makes sense, because cloud servers are encrypted and monitored by experts who look for odd behavior. These servers also make it easy to give and remove access permissions. The next one is create an equipment policy. So secure any company devices first before giving them to your employees, and install security measures such as firewalls, pop-up blockers, email filters, and other apps that might fight against risks unique to your industry. The next one, automate what you can. Implement a system that regularly checks passwords and reminds you to change them on a regular basis. Implement technology that assesses server and firewall configuration, so it warns you if there are any holes or if there are any leaks. And instead of asking employees not to download unfamiliar content, take it a step further and implement filtering on emails and internet browsers. That way, there's an extra guard in place to prevent employees from accidentally clicking on malicious websites or malicious emails. Then train and educate. Training your employees obviously helps because they will notice malicious behavior on websites and malicious behavior in others as well. And training also helps in identifying any negligent behavior in themselves, because they might not know that the way they're acting is negligent and it might land them into trouble. So yeah, train them. Training helps with the culture of the company because it shows everybody that you're security minded. You're putting privacy and security first. Use encryption. If you're dealing with private data regularly, encryption is vital. You can't do without it. You can only decode encrypted documents or emails once you have the associated encryption key. And also it protects data in case it's accidentally sent to the wrong email, or if a work laptop is stolen or the data somehow ends in wrong hands. Then there's user authorization and accessibility. Only give employees access to files that are necessary for them to complete their jobs. To prevent hackers from accessing accounts not meant for them, implement multiple levels of authentication and insist on complex passwords. Track data and monitor usage. So even though there's a bit of an ethical battle about this, system monitoring is probably not a bad idea. It's an additional layer of security for your company. Insider behavior monitoring will allow your HR department or your IT department to replay computer usage. This way, they can keep a track of who's accessing what files. They can follow sequences of who's saved or sent something where and when. Patch management. Patch management is something that you should do because computer software is quite vulnerable. So, and this is what hackers exploit. So, whenever you've got patches that are out of date, make sure you install the latest patches and they are secure. So don't have any software that's out of that's not the latest and that hasn't been regularly updated, because you're going to miss out on patches. Regular audits and assessments. Perform vulnerability assessments once a month or every week, and regularly scan security controls and contents of every system in the network, internal as well as external, so that you can identify threats and be prepared for any attacks. And finally, back up your data. If your data is stolen, at least you can get a backup. If it goes down in any other way, at least you've got a backup. Some cyber criminals will basically just want to stir the pot by deleting all your data and nothing else. Lastly, let's look at bribery and corruption. So we all know what bribery and corruption is, but obviously this can affect your reputation, because if your organization is found to be soliciting bribes, or your employees, go to your vendors or your customers and try and find partners on the other side, it can look very bad for your organization. So this is something that definitely you need to deal with. I think I won't go through all of these types of frauds because they're fairly obvious. in terms of preventing and detecting bribes, have a strong code of ethics. And the next chapter, in fact, we're going to look at is a code of ethics. Ensure those at the top levels of the company set an example that makes it clear that bribery and corruption are not tolerated. So, your zero tolerance policy, the people at the top have to live it. Discipline employees who breach the company's code of ethics or code of conduct. Conduct due diligence on all third parties that your company does business with, and look out for product substitution red flags. For example, high numbers of tests or failures, unusually high numbers of repairs or replacements, lack of warranty information in packaging, unbranded packaging, products that don't look like the product that you ordered. And then conduct a risk assessment to look for areas to watch more closely, and train all employees on bribery and corruption prevention. And finally, reward employees for ethical behavior. Can't understate that one. Now, let's look at a code of conduct. I think this is perhaps one of the most underplayed areas, but organizations that know the value of the code will invest a lot of time in not just having a code. It's very easy these days to have a code because, thousands are available. You can get best practice examples, thousands of them really. So that's the easy part. The difficult part is making it part of your organization. How do you make this a live thing? That's the difficult part. And the best organizations do this very well. And we're going to look at how they do this. So what do you have? Do you have a code of ethics or a code of conduct? In fact, the two are both unique. They're not the same thing. A code of ethics governs decision-making, and a code of conduct governs actions. So they both represent two common ways that companies can self-regulate. They are often associated with large companies. They will have both, and they provide direction to employees and establish a public image of good behavior. So the difference is a code of ethics. Sometimes it's also referred to as a value statement. It behaves like the company's constitution. So it has general principles, and these are meant to guide employee behavior. The document basically will have a set of principles that affect decision-making. Whereas with the code of conduct, this provides the meat and bones, or the meat and potatoes, or the nuts and bolts to the code of ethics. So your code of conduct, it applies the code of ethics to a host of relevant situations. In particular, for example, a code of ethics might state that all employees will obey the law, but a code of conduct will list several specific laws which are relevant to different areas of the organization operations or the industry that the employees have to obey. Similarly, your code of conduct is going to outline specific behaviors that are either required or prohibited as a condition of ongoing employment. It might, for example, forbid sexual harassment expressly, racial intimidation, or viewing inappropriate or unauthorized content on company computers. So why should you have a code of conduct? What is its purpose? Basically, it's represents a commitment to your integrity and high ethical standards in a company's business operations. It summarizes the standards of business for your company or any company, whether it's public or private, whether it's large or small. And it makes the code visible to all employees, to shareholders, to other stakeholders. So the code demonstrates a commitment to ethics and integrity in every aspect of your business operations. So essentially, the idea is to embed this in the company's mission statement and in the strategic objectives. In other words, it's basically the face of a company's culture. Yeah, it will normally showcase your principles, your values, and it provides a unified purpose to your employees, shareholders, and stakeholders. This is the thing that actually glues everything together. Practically speaking, you can read that. I'm going to read it for you. A code of conduct defines acceptable practice and behavior in the workplace, and it helps guide them. Employees know where they and others stand and can use the code to support and raise their concerns about unethical, discriminatory, unsafe, or illegal work practices. In February 2020, the CNN president, Jeff Zucker was forced to resign when the network discovered that he'd been hiding a romantic relationship with another employee. While office romances are not prohibited at CNN, employees are required to disclose them. So though this incident ousted a top figure, I mean, the top guy went, CNN did the right thing by enforcing their policy as soon as they discovered the infraction. So your organizational code really has to have a zero tolerance policy, and you need to demonstrate that. So practically, that's how you apply it. It applies to everybody. Nobody's spared from it. What makes up a great code of conduct? First of all, it's written for the reader, which is your employees. So it's easy to understand, and it does not include any technical or legal jargon. It's comprehensive in that it covers all important details that may impact the daily lives of your employees and answer common questions that might arise. It's supported by leadership. It has been acknowledged and approved by the company's senior top team. And this is often demonstrated in the form of a foreword written by the CEO or managing director. It's also accessible. It's available to all employees, to current investors, potential investors, and public companies generally have to print them, in the media, so anybody can see them. And the other thing that can make your code of conduct great is that it's visually appealing. It follows a style that's clean and reflective of your organization's brand. Let's look at a couple of examples. I haven't got the codes here for you, but I'll just tell you a little bit about them. So Kellogg's company code of ethics, it serves the same purpose as a code of conduct, but it bases the document around the company's core values and ethical standards. The policy is quite attractive. You can have a look at it and appealing, and it draws inspiration from the Bay's business that they do, which is grain farms. But beyond a visual appeal, the code is also extremely well written, and it's organized. It's divided into employees' responsibilities, complete with how and why each one is key to the Kellogg's way of conducting business. It also includes several quizzes and definitions and question and answer boxes. It's designed to help employees make decisions when confronted with problems, which range from personal, social media, to conflicts of interest. And it promotes the company's culture while clearly indicating how employees should act. Starbucks, standards of business conduct. It begins by outlining the mission and values that Starbucks aims to uphold as a company. It then dives into detailed descriptions of what the organization expects with respect to work environment, business practices, intellectual property, and community involvement. In many instances, the company indicates where or who employees can refer to for more assistance or more information. The Code of Conduct also answers several questions that employees can reference when they're facing uncertainty. It has a short question and answer section, which helps readers understand how they should act in certain situations and what behavior reflects the standards created by Starbucks. One unique thing about this particular code is that it's got a unique ethical decision-making framework, which assists employees when they're faced with ethical dilemmas in the workplace. Microsoft's standards of business conduct have been drafted around one central theme, which is trust. The company emphasizes that trust is an important aspect of its operations, including with customers, governments, fellow employees, investors, and representatives. The code also offers a process to help employees make difficult decisions that reflect Microsoft's values and standards. And it provides employees with a visually appealing and easy to read document that's reflective of its values. So 3, you can have a look at, you can download these from the internet and you can have a look at them in your own time. Next, let's look at standards for forensic services. The American Institute for Certified Public Accountants have come up with this standard statement on standards for forensic services. Number 1 was effective on engagements from 1st of January 2020. Basically, the standard talks about, it's been promulgated by the Executive Committee, and it covers 3 years. It covers litigation, which has been described as an actual or potential legal or regulatory proceeding before a trial of fact, like a court as an expert witness, consultant, neutral, mediator, or arbitrator for a dispute. And the term litigation is not just limited to formal litigation, but it's inclusive of disputes and all forms of alternative dispute resolution. Just to clarify, this particular standard is applicable to American companies and to certified public accountants who are registered with the American Institute. So it obviously hasn't been promulgated in our region, but it's good to know of this standard because, like all other things, this will come down and we will be required to, our own bodies will implement this in the fullness of time. The next service that's covered by this standard is investigation, which refers to specific concerns of wrongdoing when compared with audit. And the member is engaged to conduct procedures to collect, analyze, evaluate, or interpret certain evidential matter. And we're going to look at what's evidence to assist stakeholders, for example, either the client or board of directors or a regulator in reaching a conclusion on their concerns. And this also applies to services provided under valuations of businesses, especially when those become part of a litigation or investigation engagement. So when you're valuing something because there's a dispute, then you need to follow this standard. The standard does not apply to a member who performs forensic services as part of an attest engagement. So, if you're doing an audit and you're basically using forensic services in an audit, this standard doesn't apply to you. And also the purpose for which the member was engaged, for example, litigation investigation, as opposed to the skill set employed. So they look at the engagement type as opposed to the skills. So even if a investigator is doing a non-investigation assignment like an attestation, then they're not bound by this. They're only bound if they're doing litigation or investigation. And data analytics services or data analysis is also covered as soon as it is part of litigation or investigation. So if you're doing one kind of service and then you move to another service and that service becomes part of litigation or investigation, then you immediately need to modify your scope and your TORs with your client, and then you know that you're covered by this. It's also not used for internal investigations. So a couple of standards. The member who's providing the services should not subordinate his or her opinion to that of any other party. They're required to maintain integrity and objectivity. That's probably a given, but integrity here is defined as, among other things, being honest and candid within the constraints of client confidentiality, and should not be subordinated to personal gain and advantage. And then objectivity is defined as a state of mind whereby the member has an obligation to be impartial, intellectually honest, and free of conflicts of interest. And specifically for expert witness services, the moment there's a litigation or litigation, then you can't have a contingent fee arrangement, because that would may cloud your impartiality and could create conflicts. So anybody acting as an expert witness, you've got to have a fixed fee arrangement. You can't have contingent fees. Also, a member performing forensic services is prohibited from making an opinion regarding the ultimate conclusion of fraud. So you can't in your report say, I've got this particular evidence and this person is now accused of fraud. You should avoid that, because only a trier of fact, a court or an arbitrator, can actually determine, after they've looked at the evidence, whether this is fraud or not. So let's look at evidence. Let's go back to where we started. Do you remember in our first part, this was one of my opening slides. I discussed what is fraud and what are the elements required to prove fraud. So today we're going to look at this in a little bit more detail. And we said fraud has these elements. First of all, it's got to be material and it's got to be false. So it's a material false statement or action. The second thing is that the intent has got to be there, that there was knowledge that the statement was false when it was uttered, or the action, what you're doing, is false and it's fraudulent. It was known, it's not just an error. Fraud doesn't happen by error. And then the fact that the victim relied on it. So there's reliance on the false statement or action by the victim. So there's deception. And lastly, damages or potential damages. Sometimes, the damages haven't happened because you've acted, but, the fraud has happened. So damages or potential damages resulting from the victim's reliance on the false statement. So when we're looking at evidence, this is what you got to look at. This is what you have to prove or disprove. This is what you live or die by. When you go to court, this is what the judge is going to look at. If you're acting as an expert witness and you're under cross-examination, this is what's going to govern whether you stand or fall, whether your report stands or falls. So let's look at the rules of evidence. First of all, a good investigator needs to have a complete understanding of the rules of evidence and how to prepare a thorough evidence-based report. This is very different from your traditional audit report or even special audits report. This is a report that is going to have a lot of annexures, a lot of appendices, exhibits, which are evidence-based, and everything that you say in the report must be supported by evidence. So it's a crucial skill set, and it's paramount to the success or failure of an investigation. So the simple definition of rules of evidence is that it is a methodology that provides information to prove or disprove a fact or a situation. In this context, it's important to distinguish between what is information and what is evidence. So information is just that, it's information. However, it can become evidence when it's used to make a decision or to support a theory. So that's when it becomes evidence. Okay, when you use information to support a decision, to support a claim, to support a conclusion that you're making in your report, then that is your evidence. And there are basically two principles of evidence, which is basically relevance and weight. So let's look at what those are. Probably the most fundamental rule of evidence states, with a few exceptions, that relevant evidence is admissible and irrelevant evidence is not. So information is said to be relevant if it tends to prove or disprove a fact in issue. In fraud or corruption investigations, this means that a piece of evidence is probably relevant and hopefully compelling and convincing if it tends to prove or disprove an element of proof of an offense, including proof of knowledge and intent. Do you remember we said these are parts of of what you need to prove? So you need to prove not just the action, but also knowledge and intent. This means that any person who's doing an investigation must know the elements of proof, what we've just been through, and also the type of evidence, whether it's direct or circumstantial, that would be relevant to proving them. And they must be able to apply that knowledge in every stage of the case. So for example, at the case planning stage, you need to ensure that all potentially relevant evidence is identified and a provision is made for its collection. In the conduct of the investigation itself, you need to ensure that all appropriate questions are asked and that all pertinent documents and data is collected to the fullest extent possible. And when it comes to report writing, you need to ensure that all of the relevant evidence is included and irrelevant evidence is excluded in accordance with the elements of proof. Let's look at weight. Several factors affect the weight of evidence. It's, in other words, its reliability and its persuasive power. And these, most importantly, are the source of the evidence. How does the witness know what he or she is testifying to? Whether the evidence is direct or circumstantial, and also the credibility of the witness, and finally, the source of the evidence. The source of the evidence refers to the basis for a witness's knowledge. For example, is the witness testifying to what he or she knows for a fact, or what the witness overheard on, say, the train or car, or what the witness supposes or thinks that might have happened? Obviously, evidence of which the witness has direct personal knowledge is considered to be weightier than information overheard from another person or any supposition that he's making. And therefore, investigators should always look out for witnesses with direct personal knowledge. Although in practice, this is not so easy because as you will see, it's not that easy to find direct evidence. In quite a lot of circumstances, you will be relying on circumstantial evidence. So what is direct evidence and what is circumstantial evidence? Direct evidence, I mean, as the name implies, is evidence that tends to prove a fact directly. For example, a statement from an eyewitness. the cancelled check used for a bribe payment, or the confession by a subject. All of these are direct evidence. Direct evidence is usually considered to be the strongest method of proof, but circumstantial evidence, which is indirect evidence, which is evidence that proves a fact indirectly or by inference from other facts. This can also be quite persuasive, but the trick is to present it correctly. So, to be convincing and admissible in court, circumstantial evidence has to be, first of all, relevant. Of course, we just talked about that. And that is, it has to prove or disprove a fact in issue. It's got to be cumulative. That is, it's not just limited to one isolated piece of evidence, but of several interconnected pieces. For example, a husband not only comes home late without an excuse, but he has lipstick on his collar, his breath smells of liquor, and a matchbox emerges from his pocket from the Hilton Inn lounge. So you can see here cumulative multiple pieces, interconnected pieces of evidence adding up to provide strong evidence. The other quality that you want to have in circumstantial evidence is that it's tightly organized and clearly presented. Many cases for circumstantial evidence, they fail not because the evidence is weak, but because it's simply not presented in an organized way. It's presented in a disorganized way. It's presented in a confusing manner. The person himself doesn't know how to put it. And because of that, the judge or the fact finder, the arbitrator, can't understand it. And because they can't understand it, they fail to make a decision in your favor. And finally, to be persuasive and admissible in court, circumstantial evidence must exclude all possible innocent explanations. So the evidence that you provide must exclude anything that is sort of logical or direct. Let's give an example of a circumstantial evidence. We'll give a couple of examples, actually. We'll give an example on bribery, on collusive bidding, and also on proof of knowledge and intent. So in the case of bribery, for example, in a case in which a witness admits paying a cash bribe to a government official, for which there is no other direct evidence, the steps of proof might include circumstantial evidence to corroborate any direct evidence. So for example, the investigator could record in detail when, where, how, why, etc., the statement of the witness that he paid the government official in cash. This is direct evidence. So recording in detail the witness statement, all those elements, when, where, how, why, the witness paid the government official. This is direct evidence. Next thing, proof that the government official spent or deposited a significant amount of cash shortly after he allegedly received the cash bribe. This is also circumstantial evidence. You're trying to show a connection between a certain amount of money coming across this government official and him spending it and the time of the fraud. And then thirdly, you eliminate all possible potential sources of income for the official's cash expenditures or deposits to whatever extent is possible. So you do a lifestyle audit, or you know what this government official is earning, you know whether he's got any other income from business or property or anything else. You've got a rough estimate, and you know that within the last 10 years, there's no way this person could have made so much money to, say, for example, amass wealth to buy 10 properties, in the richest suburb. This is good proof, circumstantial evidence, but good proof. Where did this money come from? And finally, interview the subject official and show that the official cannot explain the source of the cash expenses or deposits, or that he's lied about it. This is also circumstantial. So Such evidence, if presented properly, is likely to be believed by the jury, and it's legally sufficient to convict a defendant in most courts. Let's look at the example of collusive bidding. In these cases, the investigation often begins with the identification of unusual bid patterns, such as bids being too close or exact percentages apart. Sometimes they just use a formula to hike prices, and then they pass that formula to their colleagues on the other side, who then get the bid. So yeah, if you've got a certain person winning, just do a quick maths and you might find there's a correlation there. So this can be considered circumstantial evidence of collusion, and it might be admissible. However, something that's even more effective is to use unusual bid patterns as well as any leads to direct evidence. For example, if there's communication between the bidders or any admission by the subject, then you can use both the direct evidence, which is admission or communication, email communication between the subjects. And that's why we said, if you remember in one of our webinars, we said you can do a disk imaging and do a covert investigation before anybody is interviewed. This is the kind of evidence you're looking for. Finally, let's look at circumstantial proof of knowledge and intent. So proof of knowledge and intent, or proof is, for example, that the subject knew that a document was forged and submitted it with the intent to defraud another party. This, we know, is an essential element in fraud, and in fraud and also in corruption cases. And we also know that when this happens, there are no unintentional bribes or accidental frauds. I mean, if there's a bribe, it was very deliberate. So provided you can get hold of the bribe, you might be able to then, you can infer that the state of the mind of the subject was that he wanted to commit fraud. So courts permit this. Courts will permit inference from facts and circumstances as circumstantial evidence. Some of the circumstantial evidence of knowledge and intent in a fraud investigation might include, among other things, proof that the subject or somebody acting at his or her direction, they did a few things. For example, they altered or forged a relevant document, such as a supporting document with a bid or invoice. They deliberately destroyed a relevant document or improperly withheld it from the investigators. They deliberately lied to investigators or to another party about a material point to hide their guilt. For example, in a bribery case, they might lie about the source of certain wealth. And such lies in court are known as false exculpatory, or that they deliberately obstructed the investigation by example, instructing or threatening a potential witness not to meet or to cooperate with investigators, or that they deliberately committed similar prior acts. So if they've got a prior history or a pattern, then this is pattern evidence, and this can also be used in a court of law. The rationale for the above methods of proof, they're usually, when you have all these circumstantial evidences proved together, one of the things they referred to as normally is badges of fraud. So, you're looking for badges of fraud to sort of label the fraudster with. And once you've got enough badges of fraud, then you can bring it together to make a substantial case. Right. That brings us to the end of the presentation for today. I'd like to thank all of you for having joined us, particularly for those who've been with us from the first presentation right through to this last one. What I would like to say is that this is not the end. We're going to have lots of presentations in this particular field, but also in other related fields. For example, in internal audit, evaluation services, matters concerning optimization of processes such as finance, governance, which can help the board and senior management. So we're going to bringing you a whole host of other webinars. Stay in touch, and we'll inform you as soon as we're ready with those webinars, possibly in the next few weeks. Thank you so much, and it was an absolute pleasure presenting to you. I hope you've enjoyed these webinars, and I look forward to seeing all of you in the very near future. Thank you.
Thanks, Zahir. I am glad you ended with giving us that consolation that this is not the last that they will be hearing from us. And I must say, while we were going through the presentation, especially the exciting parts for me, there was one thing going through my mind: this is the last part. And one of our attendees, Muhammad, rightly stated it in the comment section. He said, sadly, this is the last part. So I'm glad that you have emphasized that we'll have others. Otherwise, we want to thank you, Zahir. I think we've done a very good job at this. And from today's conversation, I like that you walked us through the most common types of fraud, but also gave us measures on how these can be prevented. But I also like that you gave examples that we can all relate with, especially with the Microsofts of this world. And so to our attendees, we'd like to thank you for taking time for all the segments we have had right from part 1 to where we are today. And like he said, this is not the last time. We will surely keep in touch with all of you and keep you updated on any other sessions we will have coming up. Zahir, out of all this, part 1, part 2, part 3, part 4, what are the key takeaways we need to have? What are those things we need to work with at the back of our minds every other day in our operations?
Thanks, Moses. I think the key for me is the reality that every business, on average, loses 5% of its revenue, of its top line, to fraudsters every year. This is reality. This is not some science fiction picture. This is reality. Every survey that has happened since 1996, based on the investigations that have the material that's been provided to the Association of Certified Fraud Examiners every 2 years, they've looked at the size of the companies, they've looked at the size of the frauds, and they've concluded that this is a common, irrefutable fact. 5% of your top line is going to fraudsters. If you can stop this, then you've got a huge competitive advantage straight away, because you've got 5% more than your next competitor who's not working as hard to stop fraud. The other thing is there's a very positive spin to this. And the positive spin to this is you begin to create ethics and integrity in the organization, in individuals. And guess what? How do we build a society that has very high morals, that has very high integrity? It starts with the individual. So if we're not just giving jobs to employees and we're not just asking them to do tasks, which result in a payment at the end of the month, but we're actually helping them to become better people, to have better standards because they've worked with, A-class organization for years and years, and that's transformed them, that's transformed their lives, then really we can make a significant impact, not just on the organization itself, but on individuals, on families, on society as a large. So I think what we're talking about today has a huge role to play in organizations and in societies. And, obviously, the more we do of this, the better everybody benefits. One of the key ways of lifting Africa, East Africa, Sub-Saharan Africa, we always feature in the bottom worst countries when it comes to the corruption index, the bribery index. We're always right at the bottom. And one of the ways to lift ourselves out of this is to set examples at our level. If we can do this, we can transform our employees, we give them a good experience, we shut out the fraudsters, we're quick to catch fraudsters and bring them to account, then I think, we're already doing big things to make a difference to our country and to the nation as a whole.
Thanks, Zahir. Indeed, one of the ways we can change our stories by living the example at our level. So our prayer as a firm is that all of the participants we have here get to live up to the conversation that we've had today, and that we would have achieved our satisfaction. But also all the information we've shared with you is just to give you the basic understanding of fraud, so that at any one point you interface with it, you have a start point. And when you have further challenges, we will remain at your disposal. Zahir is here, the entire team at BDO is here. Zahir, I wish you could flag that slide that has your email address.
Certainly.
Yeah, so Zahir is here, the whole team is here to support you at any one point, whether it's fraud or audit or taxation, and it doesn't matter what part of the world you are, we have a network that can reach several parts of the world.
Sorry, I'm doing this the Juakali way, so just bear with me. Right, okay, there we are. Yeah,
the result matters.
My email address, if you want to write it down, it's Zahir, ZAHIR .Sheikh, SHEIKH at BDO hyphen East Africa, EA.com. And my direct mobile number is 0722 786 813. And no toll charges apply. So you can call me anytime.
Right. Thanks, Zahir. And thanks to the entire team that has been working with us in the background for making this whole series a success. We will see you in our next series, which we will let you know when they will be running. Otherwise, we thank you very much.
Thank you and bye-bye.
Cheers. Zahir, as we close this, there's a number of kind words for you in the chat section. You might want to go through those.
Yes, I'm looking at it now. Thank you. Thanks, Moses, and thanks to everybody for your kind words. I'm overwhelmed. I'm overwhelmed that this was so positively received, and I'm really looking forward to being back with you guys very, very